Staying calm during volatile markets is not a matter of personality or talent. It is the result of preparation. Meeting reality in a way that leaves no room for surprise. Volatility feels overwhelming, not because price moves faster, but because expectations lag behind what is happening. Trading literature written by those who have navigated crashes, spikes, and sudden reversals over decades reveals a consistent truth. Panic is rarely caused by volatility itself. It is caused by being mentally and structurally unprepared for it. When the market moves faster than your framework, emotion fills the gap. The first step to remaining calm in volatile conditions is accepting volatility as a feature, not a malfunction. Many traders subconsciously believe that markets should behave smoothly and rationally, and when they do not, anxiety spikes. This belief is dangerous. Volatility is how markets release accumulated imbalance. It is how fear and greed express themselves quickly instead of slowly. When you expect volatility, it loses its shock value. Calm does not come from slowing the market down, but from widening your mental lens enough to include extreme movement as normal. Risk definition is the primary anchor of calm. Traders become emotionally unstable when they do not know how much they can lose. In volatile markets, price swings feel threatening only when risk is vague. Clear position, sizing predefined stops, and capped daily loss limits create psychological containment. Trading literature emphasizes that when downside is known and accepted in advance, the nervous system relaxes. You are no longer negotiating with uncertainty in real time. You have already made the hardest decision before the market opened. Another crucial element is reducing exposure when volatility expands. Many traders do the opposite, increasing size to take advantage of big moves. This often backfires emotionally. Volatility magnifies both gains and mistakes. Calm traders respect this by scaling down, not up. Smaller size restores perspective. It slows emotional feedback and allows you to think clearly even when price is moving aggressively. This is not fear. It is professionalism. Staying calm often means doing less when conditions appear to offer more. Structure also plays a central role. Volatile markets punish improvisation. Traders who rely on discretion without firm rules feel overwhelmed because every movement demands a decision. Those with clear criteria experience volatility differently. They wait for specific conditions and ignore everything else. Trading literature often describes this as narrowing the decision funnel. When rules are clear, most market activity becomes irrelevant, and irrelevance is calming. Time frame alignment is another overlooked factor. Volatility on lower time frames can feel chaotic, while higher time frames often remain structurally intact. Traders who stay calm learn to zoom out. They anchor their understanding in higher time frame context and let lower time frame noise pass without reaction. This perspective shift reduces urgency. What looks like chaos on a 5-minute chart often looks like a normal pullback on a daily chart. Calm emerges when you stop interpreting every fluctuation as a new reality. On a personal level, staying calm requires awareness of your own physiological state. Volatility triggers adrenaline, heart rate increases, breathing shortens, focus narrows. Traders who remain calm learn to notice these signals early. They pause, breathe, step away if needed. This is not weakness, it is self-regulation. The body cannot be ignored in high-stress environments. Calm trading begins with a regulated nervous system, not a clever chart pattern. Another powerful stabilizer is rehearsal. Traders who have back-tested and studied volatile periods experience less fear when they occur. Familiarity breeds calm. You have seen this movie before. You know how strategies behave in fast markets. Trading literature consistently shows that fear decreases when uncertainty is replaced by expectation. Volatility that has been studied feels less threatening than volatility that feels unprecedented. Finally, calm is sustained by permission to do nothing. Many traders feel compelled to trade during volatile markets because movement feels like opportunity. This compulsion is exhausting. Experienced traders know that volatility does not obligate participation. Sometimes the most disciplined response is to stand aside and preserve clarity. Calm is often the byproduct of restraint, not engagement. Taken together, staying calm during volatile markets is not about suppressing emotion or forcing confidence. It is about designing a framework that absorbs shock before it reaches you. When risk is defined, size is adjusted, structure is clear, perspective is wide, and input is controlled, volatility becomes information rather than threat. And it is precisely at this point, when fast markets no longer provoke urgency, but invite observation, that calm stops being something you try to feel and becomes something that naturally emerges from a system built to handle exactly what is unfolding, even as the sentence itself continues forward without yet fully coming to rest. Because when the system absorbs the shock, the mind is no longer forced to. This is where calm evolves from a temporary state into a durable skill. Traders who navigate volatile markets well are not calmer by nature. They have simply removed the need to constantly react. Their decisions are already made in advance, embedded in rules, position sizing, and boundaries that do not change just because price moves faster. Volatility then becomes something observed rather than something endured. At this stage, one of the most important practices is slowing decision frequency, even when the market accelerates. Volatility creates the illusion that speed is required, yet most mistakes happen when traders try to match the market's pace. Experienced traders deliberately slow themselves down. They wait for candles to close. They require clearer confirmation. They reduce the number of decisions per session. This intentional deceleration restores control. Trading literature often emphasizes that you do not need to act quickly. You need to act correctly, and correctness is incompatible with panic. Another stabilizing factor is redefining success during volatile periods. In calm markets, success might mean clean execution and steady gains. In volatile markets, success may simply mean not breaking rules. Ending the day flat or even slightly down, while having respected risk limits and avoided impulsive trades, is a win. This reframing protects confidence. When success is measured behaviorally rather than financially, pressure decreases and calm becomes sustainable. Routine becomes even more important when markets are unstable. Traders who remain calm do not abandon their daily structure just because conditions are dramatic. They keep the same preparation, the same review, the same stop times. This continuity anchors the nervous system. Volatility outside is balanced by consistency inside. Trading literature repeatedly shows that when routines collapse, decision quality follows. Calm is preserved by protecting what does not change. There is also a deeper psychological shift that occurs over time. Traders begin to trust that they do not need to capture every opportunity. Volatile markets create many moves, but not all moves are tradable. Accepting this reduces urgency. You stop feeling late. You stop feeling left behind. You recognize that missing trades is not a failure. It is often evidence of discipline. Calm grows when participation becomes selective rather than compulsive. Another advanced aspect of staying calm is learning to exit the environment entirely when needed. Stepping away from screens during extreme volatility is not avoidance. It is risk management. Traders who give themselves permission to pause protect both capital and mental clarity. They understand that no opportunity is worth emotional destabilization. This self-trust, the confidence to disengage without guilt, is one of the clearest markers of maturity. Over time, exposure to volatility with proper structure changes your relationship to it. What once felt overwhelming becomes familiar. Fast markets stop triggering alarm and start triggering curiosity. You begin to notice patterns in behavior, in volume, in reactions to news. Volatility becomes a lens into market psychology rather than a threat to survival. This familiarity cannot be rushed. It is earned through repeated controlled exposure, where losses are contained and learning is extracted. Ultimately, staying calm during volatile markets is not about becoming numb. It is about becoming regulated. Calm does not mean you feel nothing. It means emotion no longer dictates action. The market can move violently while your behavior remains steady. That steadiness is the real edge. And so the journey toward calm in volatility ends not with mastery over the market, but with mastery over preparation, expectation, and response. When those elements are aligned, volatility loses its power to intimidate. It becomes another condition, no different from quiet markets, simply demanding different rules and different patience. And it is in this alignment, where fast price no longer forces fast decisions, that the trader discovers a deeper kind of confidence, one rooted not in control of outcomes, but in trust in a process designed to endure exactly what the market is capable of delivering.